Hello and welcome to Portfolio Matters, weekly update, week 50. And we have had a big data dump this week, so we've got a lot to get through. But before we start, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Okay, so first of all, some news. Well, we had the various central bank meetings this week, and the Fed indicated that it was going to accelerate tapering so that QE ended by March, and signaled that it expected 3 rate rises next year, although it left interest rates unchanged for now. The Bank of England raised rates from 0.1% to 0.25% as inflation runs at 5% plus. ECB left rates unchanged, but signaled that the pandemic emergency purchase plan would end by March, so they are rowing back on QE.
But they are going to maintain their monthly QE bond purchases at 40 billion for the time being.
Yes. Okay, now we've had a load of economic data this week, so we're going to try and run this through this quite quickly. So UK GDP growth for October year on year came in at 4.6%, which was down on September and below expectations. The UK balance of trade, and we will show you a chart, was minus 2 billion in October, which was down from September and below consensus expectation, which on the surface looks quite good news, but actually the UK balance of trade basically gets more negative the better the UK economy is doing. And the only time it goes positive is when the UK is doing really badly and goes into recession, as you'll see from the chart coming up. UK manufacturing year on year in October was only 1.3%, which was down from September, but slightly ahead of expectations. Construction output slowed substantially to 1.4% year on year, which was below September and below expectations. UK unemployment was good, 4.2% down from September and matching expectations. Earnings growth, including bonuses, 4.9% in October, which was down from September, but ahead of consensus expectations. Excluding bonuses, it was 4.3%. So earnings growth is well ahead of the Bank of England's 2% inflation target. And that is evidence of a wage price spiral developing. Now, the big news was that we had UK inflation data for November, came in hot, 5.1%, up from October, up substantially from October, and slightly ahead of expectations. Core CPI came in at 4%, which was well above October and matching expectations. RPI came in at 7.1%, a big leap from October and ahead of expectations. So UK inflation continues to rise and continues to beat expectations. UK producer price inflation for November was 14.3%, a big rise on October. Output inflation was 9.1%, above October and well above expectations. Expectations were for output inflation to actually fall. Retail sales growth for the UK in November was 4.7%, which is a reassuring number. Remember, in October, retail sales had actually fallen year on year, and that beat expectations. So the UK consumer is strong. Now, I had some PMIs. In December, and these are flash numbers, UK services PMI fell to 53.2. Remember, 50 is the border between expansion and contraction. That's a big fall on November and entirely expected given Omicron. UK manufacturing PMIs were surprisingly resilient, 57.6, only slightly down from November and above expectations. And the composite took a big dip to 53.2, so still expanding, but well down on November. In the US, we had inflation figures for November, and they also came in hot, up 4.9% core, which was above October, matched expectations. The CPI was 6.8%, well up on October, but slightly below expectations. Remember, the Fed has a 2% inflation target. And all that is feeding through to raised consumer inflation expectations. So the December number for the University of Michigan 1 year ahead consumer inflation expectations was 4.9% in December, which matched November. And for the 5 year, it's 3%, which was slightly below expectations. The University of Michigan Consumer Sentiment Survey for December came in at 67.8, which is very reassuring, up on November and well ahead of expectations. Housing starts for November were great, a big leap, at 1.679 million new homes annualized, which is up from October and well ahead of expectations, and that is an 11.8% rise month on month. And remember that construction, new homes, is a big driver of economic growth, because when you move home, you have to buy new furnishings, etc., etc. And we had PMIs for December. Manufacturing came at 57.8, slightly down on November, but resilient in the face of Omicron. The services PMI came at 57.5, only slightly down on November. Amazingly resilient. And US composite 56.9 versus 57.2 in November. So the PMIs in the US are showing that the economy is really resilient in the face of Omicron, much more than in the UK. In the EU, new car registrations for November were down 20.5% year on year, which was an improvement on October. Now, remember last week we covered UK new car registrations, which actually rose year on year. So that is a surprise and a puzzle. It seems that car manufacturing in Europe is still suffering from supply chain problems. The EU PMIs, so manufacturing came in at 58, only slightly down on November. Services came in at 53.3, a decent drop and entirely expected given lockdowns, etc. And the composite was 53.4, down from 55.4 in November. In China, figures for November, industrial production rose 3.8% year on year, which beat expectations and was up on October. Retail sales were 3.9% though, and that was a fall from October and below expectations. And the unemployment rate actually ticked up to 5% from 4.9% in October, which is concerning.
Thank you, Keith. So the first chart we've got for you today is the Fed's dot plot chart, where they project their expectations for interest rates going into the future, and this creates the dot plot. You could see where they think it's going, where interest rates are going to go, whereas as opposed to where the market thinks that interest rates are going. So the Fed dot plot is indicating that there's an expectation by Federal Reserve governors that interest rates will reach 2.5% in the longer term, and the market is basically projecting out to 2024 a lower level of interest rate increases. I think historically that the Fed dot plot has not been particularly accurate. Would I be right in saying that, Keith?
No, I think you're right, but it indicates what their expectations are. And obviously, it's the Fed's record in forecasting is very poor, but it shows what their intentions are. So this shows precisely what Richard was saying. The dark red dots are where the Fed Open Market Committee expects interest rates to be, and the blue dots are where bond yields are. So the bond market doesn't think that the Fed will be able to raise rates as high as they do.
So the ECB's inflation expectations, we discussed this last week, or recently at any rate, and basically we know that the ECB is continually predicting that inflation is going to go down from where it is now. And this is doing the same thing. So on the basis on which they make these projections is a mystery.
Yes, and more to your point, Richard, about central banks' forecasts. Essentially, they're not very good. They chase the data.
I'm afraid so, yeah. The US inflation expectations rose slightly after the Fed announcement. So one of the things I think about the Fed announcement, the way I look at it, is up until now, they've been saying that inflation is transitory. And the market has, to a significant extent, I think, believed them. And now they're saying it's not transitory. And the market is starting to think, okay, so what if the Fed is right and it's not transitory? And I suspect we're going through sort of a psychological change in the viewpoint of the market.
Well, I think when we look through the bond yields going towards the end of this weekly, Richard, you'll see that bond yields are just astonishingly low.
Yeah, they're not necessarily a reflection of people's inflation expectations. They may be more an expectation of people, of what people believe the Fed can actually do.
Right. Yes, that's true. I completely agree with that. So what we're saying is that bond yields don't reflect inflation expectations anymore.
Possibly, or somewhere in between.
Yeah, we showed some really interesting charts last week, which showed that the bond market essentially did not follow US interest rates. So something else was driving it. And what we're saying now is that actually the bond market is also ignoring inflation. So,
and a few weeks ago, we had the chart that Lynn Alden had prepared, which showed that the bond markets aren't actually very good at anticipating inflation. If you take the total expected return that is delivered before an inflation peak arrives. So,
yeah. So all that leads me to basically puzzle over the bond market. I don't understand what is going on. If a member of our audience has some expertise in this and would like to come on and explain what on earth is going on in the bond market, then please get in touch. We would love to hear from you.
So the news of the impending taper by the Federal Reserve didn't throw the markets into a tailspin, I think because the markets were expecting something of that nature to occur.
Yeah, and also I think there was the danger the Fed would raise rates, which they didn't do. They were surprisingly dovish.
This is the UK balance of trade. As Keith points out, it's almost continually negative, except for just prior to actually the COVID period, and then post-COVID. And I guess, Keith, having a negative balance of trade is one of the penalties you pay for being the world's reserve currency, isn't it?
Yeah, that's true. But I don't think the GBP, the Great Banana Peseta, is anywhere used as a store of value these days.
Depends on your definition, Keith.
Well, compared to the Turkish lira, we do want.
Yes, exactly. And the UK unemployment rate is looking very healthy. It's almost back down to where it was just prior to COVID, and below where it was for the entire first decade of the 20th century.
Yeah.
21st century, I beg your pardon. And UK average weekly earnings growth is falling off a little bit actually from the peak in the summer. So I think we just have to, remains to be seen what this graph does in terms of a inflationary wage spiral. We're clearly not in one at the moment yet. Whether we get into one obviously remains to be seen. CPI inflation, however, is looking very unhealthy and showing no signs of turning at the moment, as is UK core CPI inflation, which is actually the highest it's been since certainly this chart began in around about 1997. RPI inflation, which always used to be the main number that people measured inflation against, and this is significantly higher than it's been in the last 25 years and marching upwards at an alarming rate. In manufacturing PMIs, as Keith said, the PMI and the service PMI between them are showing a reasonably healthy state in the UK economy. We hope that the PMIs don't continue to fall, though, to below 50, because then we'd be in a contractionary phase, which would be unpleasant. And we don't yet know what the effect of Omicron will be. We know it's having a fairly significant effect, actually, on the leisure and entertainment sector, with takings down around about 40% over the last few days. How that will feed through into other economic activity in the UK, we don't yet know. And the composite PMI. US inflation is looking dangerous, I would say, as is US core inflation, which is dramatically higher than it has been. And consumer inflation expectations are unprecedented, in fact, if you look over the last 15 or so years.
Actually, just going back to the core inflation rate, Richard, what happens with the relationship between normal, so wider CPI and core, is that initially you get an increase in inflation, which then broadens out into the economy. So if you get an energy price spike, that feeds through into CPI, but then all the kind of different agents in the economy then start to raise their prices, and you get a broadening of inflation that feeds through into core. And that is exactly what we're seeing. Yeah,
good point, Keith. Consumer inflation expectations, I would say that these are remarkably muted, the 5-year expectation. I would have thought it would be higher given where we currently are. Clearly, it's in a significant uptrend.
Yeah. Still, it's like 1% above the Fed's target, which they should be concerned about.
The University of Michigan consumer sentiment chart is looking a little bit unhealthy. It's fallen significantly from where it was at the beginning of 2020 to where it is now. And it could do with an uptick, I think.
Yeah, we know that there's a huge difference in consumer sentiment between Democrats and Republicans in the US, with Republicans feeling really rotten and Democrats feeling all right.
US housing starts year on year, looking at US services PMI, well above 50, neutral position. And US manufacturing PMIs significantly high, actually.
Yes.
And indicating a healthy manufacturing economy, and the composite figure is looking healthy. EU manufacturing PMI has fallen off its post-COVID peak, but it has arrested its decline and is sitting between 55 and 60. So let's wait to see where that goes, but nothing to worry about there.
Yeah, very healthy compared with 2019, actually.
Yeah. And US services PMI looking a little bit less healthy, but still well above 50, and at around about the level it had been at for the previous 6 or 7 years prior to 2020. And the composite is showing us all. It doesn't look that healthy, the composite, does it?
Well, given these are December numbers and we've had Omicron, I think they're surprisingly resilient. I'm really surprised by the service PMIs, because I mean, if you, like, Austria's completely shut down the economy, they must be in recession. So the services sector. So The Dutch are locking down. I'm amazed that these numbers remain above 50. I'm actually quite impressed.
Well, I think the effect of Omicron throughout Europe is probably, and including in the UK, has yet to be felt in full. And we're going to talk about it later on. But I think we're at the beginning rather than the middle of that journey.
Yeah.
China industrial production, it is sort of stabilized at a level which is probably below what it was prior to COVID, but is still in a healthy growth stage. And China retail sales year on year significantly lower than they had been prior to 2020, but still positive. Chinese economy is probably slowing down. The Chinese unemployment rate, they don't know how to interpret this actually, Keith, because they haven't recovered post-COVID in the way that the US, UK, and the EU have. And it really appears to be possibly stabilizing at around about 1 percentage point above the norm for pre-COVID.
Well, I mean, there's clearly a break in the data here.
Yeah.
From 2018. So it's difficult to kind of extrapolate backwards from there. But we'll have to watch this as the Chinese construction sector slows.
Yeah.
So it's something to watch going forward. Okay, on to Inflation Watch. And we have had some new data this week because we had UK and US CPI numbers, and they all were higher than October numbers. But the Bank of England raised interest rates by a massive 0.15%. And
well, can I just point out, because that is a 150% increase in the rate in the interest rate.
Yes. Well, I know from my personal savings account, Richard, that if you increase the amount of interest I'm getting on it, I might be able to buy a cup of coffee.
Yeah, as long as you go for a relatively cheap outlet.
Exactly. But the QE is due to end by March for both the US and Europe.
So this is from today's FT showing that UK inflation has reached its highest level in a decade. And interestingly, the Bank of England forecast in the top graph is for it to continue to grow, which actually shows a bit more balls, if you'll pardon my French, than the ECB has. Companies that have been raising prices and expect to continue doing so in 2022, the realized annual price growth, is significantly sharper than the expected annual price growth.
Yeah.
So that shows that inflation is catching businesses out in terms of the rapidity with which prices are going up.
Very interesting. You know that the IMF this week urged the UK to raise rates because it thought that UK inflation would continue to rise. So
the US PPI came in hot, and that is a uncomfortable looking graph for the US Federal Reserve, undoubtedly. And you note that the blue line, which is the final demand, trails the white line, and it looks like that final demand inflation is going to be continuing to increase up to what could be a very unpleasant level, actually.
Yeah, absolutely. These are numbers last seen in the 1970s.
Yes. And also, if you look at the 1970s, they are much steeper than the rises in the 1970s.
That's true, yeah.
And services prices are rising too. Yeah, well, it remains to be seen whether the blue line catches up with the white line, or the white line drops down to the blue line. But the implication is that there's an inflation throughout the US economy. Wage pressure for small businesses. So the white line, the small businesses compensation index, and the blue line is their compensation plans. So clearly, as the actual compensation goes up, businesses plan that they're going to have to increase compensation. And that is, of course, the beginning potentially of a wage price spiral.
the compensation index is the highest it's been since this chart began back in 1985.
Yeah. So a problem for small businesses, and clearly small businesses struggle with, do they raise prices and deter the customers, or do they keep prices down and take a hit to their margins? And this is, as we were saying earlier, 5-year expectations have scarcely moved this year, and they look completely out of kilter with what's going on at the moment.
Yeah, you'll notice that John Authors has mucked up the time lagging here. But so the blue line should actually be 5 years forward, and
Yes.
then the white line should be shifted into the future.
Good spot, Keith. He's done it the wrong way round.
He has, yeah. But anyway, interesting chart. And it shows that the white line, Michigan 5-year forward inflation expectations, is ticking up steadily.
Yeah.
In response to a rising inflation in the US. Well, this just shows how extraordinarily low real interest rates are. The real Fed funds rate is minus 5%. That has to be very good for demand. I mean, if you can try and lock in a mortgage or any sort of loan at current interest rates, essentially, you're instantly making money in real terms.
So markets are forecasting the rate cycle peaking at 1.75%, as we discussed a little earlier. There's a battle, isn't there? What can the Federal Reserve afford to put interest rates up to in terms of not destroying the ability of the economy to service its debts as a whole? And what is the rate of inflation? What is the rate of inflation? How can it be controlled?
Yeah, I mean, the thing about this chart, which is, bear in mind that the Fed inflation is now running at 5% plus, and PPI is running, producer price inflation is running at 15%, and end of next year, market is expecting US interest rates of around 1%, so still very negative.
So German wholesale inflation is at 16%, and that is higher than it was in 1970 to 74. And it's just extraordinary. And people who watched us since the inception of this podcast will know that I have always been very concerned about the inflationary impact of COVID. But to be frank, I didn't think that the impact would be this much this quickly. And I do think this is really worrying.
No, I completely agree, Richard. And frankly, as we go through this week's weekly, the EU energy crisis took a big turn for the worse this week. So, all energy users in the EU are facing extraordinary price increases.
Keith?
Well, this is the US quits ratio, and it's the highest it's been since this chart began. And it shows that people are quitting work in record numbers so they can move to a new job. And I was listening to a podcast in which they were saying that for every 3 people they hired, 2 people would leave for a job in the factory next door, and so companies are bidding up for labor, which is very bullish for wages.
And in fact, they'll start to make anticipatory wage increases, won't they, to stop the 2 from quitting?
Yeah.
US inflation is broad. As Keith was saying, effectively, you have a spike in one particular sector of the economy, and it will tend to broaden out to the whole economy over time. US money supply, well, yeah.
Yeah. Up, what's that? 30% plus.
Yeah.
And people are surprised we have inflation. This is really easy. Printed loads of money.
Lumber is reversing. It's extraordinarily volatile, isn't it? It's this huge head and shoulders pattern in April, in spring and early summer. I quite like it. It is a classic head and shoulders pattern. The only thing is, by the time you saw it formed, it was too late to think with it. So it's retrospectively, oh yes, look, you've got to sell that because of the head and shoulders. But now it's going back up, and I don't actually know why they're going back up. Do you, Keith?
No, I don't know, but there's an absolutely extraordinary rise. I mean, it's practically doubled in a month.
Yeah.
But as we've seen, Richard, in the US housing starts, there has been a 12% increase in housing starts month on month. So, clearly the US construction sector is doing all right. They need lumber.
Yeah. So one of the things that the Fed has done is in its inflation numbers, it's keeping house price or accommodation shelter inflation at 3%. And house prices are 19% up year on year, I think. I don't actually know what the current rental figure is, but the increase in shelter costs, even if you don't put them into the official figures, which they haven't, will feed through into the, as we've just discussed with the any particular price rise, will feed through into the general economy and cause prices to rise therein. So they can only hide it for a certain amount of time. And I think if they put it back in, it adds something like to what it actually is. It adds something like 3% to the rate of inflation in the US.
Wow. Because they do include rents from a survey, don't they?
Yeah.
Are you so Richard? Are you saying that they haven't included the
core doesn't include shelter, does it?
Right, got you. Okay.
Because we don't need shelter.
So this is the Atlanta Fed splits inflation components into flexible and inflexible. And they're showing that flexible components, i.e. prices that can move, are moving at their highest ever. This chart goes back to 1965. Flexible prices have gone up more than they did in the 1970s. Inflexible prices are starting to rise as well. To the highest level they've been in 20 years. And further evidence that inflation is broadening. So if you look at these bars, you see the blue is energy, which we know has shot up this year. The red is reopening components. So parts of the economy that were disrupted by COVID, and obviously they had big inflation earlier in the year, but that's now subsided. And we're now having inflation picking up in the sectors which were not affected by COVID. So you're seeing inflation broadening. So this, as we discussed earlier, the European power crisis continues to get worse. So these are German baseload power for January 2022. You'll see they've hit a new record. And the year ahead prices are now above 200 euros a megawatt hour. And a reminder that last year they were below 40. So they've pentupled. And this is from a couple of days ago. This was energy prices on Wednesday. And you'll see in France, they were 346 euros per megawatt hour. Absolutely astonishing.
France has a problem. It's having to shut down 4 of its EDF nuclear power stations because of problems in the pipework of cracks discovered in a 10-year inspection of cooling pipework. And there were 4 nuclear reactors discovered in one of the reactors, and there are 4 reactors of a similar design. So they're shutting those reactors down until the end of January, which is taking 10% of the nuclear power generating capacity offline for 6 to 8 weeks. And that is going to have a big impact because clearly that has to be substituted with either gas or German coal-fired power. I don't think there's anywhere else it can come from.
Yeah.
And as we know, we've got problems with the gas, which we talk about later.
Thank you, Richard. Very interesting.
So I picked this one up from the FT. Turkey raises minimum wage to help workers hit by high prices. And Erdogan has announced a 50% pay increase in the minimum wage. Well, we know what that's called, don't we? That's called a wage price spiral, and it is it's a populist. So my view about populists is that populism is a feature in politicians, not in the electorate, and this is a populist move by the Turkish president to try and placate the low-paid workers in the Turkish economy who are being decimated by inflation, and of course, it simply feeds the wage price spiral.
Absolutely. Okay, quickly on to the EU carbon price, which is very close to its highs. Now, we did an extended piece on this in a previous weekly, and then we were saying that we're expecting EU carbon prices to head towards €100 by the end of the year, and it is approaching those numbers. And we also said that European industry wouldn't be able to live with that, and that there would be pushback. Well, pushback has arrived in the form of Poland, supported by the Czech Republic, are calling for either the suspension of the EU emissions trading scheme or the injection of 400 million extra allowances to stabilize the carbon price. Watch this space. Let's see what happens.
The EU cannot so readily adjust the carbon trading scheme because it is baked into EU law. And in order to suspend or alter, it has to go through a legal process. It is not up to their discretion to change it. And that means that the situation is actually, my understanding is it's very inflexible. It may be able to be changed over the course of a number of months, but it can't be changed quickly.
No, I completely agree with that, Richard. But, at some stage, the pressures on European manufacturers are going to become such that they're not going to be able to compete, essentially, because you're not imposing these carbon taxes on foreign production, and they'll just be simply be substitution.
And it will have to change. Ultimately, it will have to change.
Okay, now we've got a big data dump from John Kemp at Reuters, giving an overview of the world economy from the prism of trade and transport. So this is world trade, and you can see that actually it's dipped down over the last few months, presumably because supply chain bottlenecks have really hit, as you'll see as we go through this. So global industrial production seems to have hit a plateau, which is frankly consistent with supply chain bottlenecks. You can't produce more stuff if you can't move it. Now and as the maritime trade routes have become clogged up, exporters have increasingly turned to air freight. So you'll see this is Narita, which is the Japanese airport, and freight has hit pretty much an all-time high, much higher than pre-pandemic. Hong Kong, again, going through the roof, new high. Heathrow is recovering, but below pandemic levels. Of course, now that we've had Brexit, a lot of exporters are bypassing the UK. UK used to be an international hub, but is less so now. This is US air freight, and again, new high. Now back to supply chain issues. This is throughput at the port of Long Beach, California, and you can see essentially it's hit a plateau. It's stalled. You can't get any more containers going through the port. This is the port of Los Angeles. Again, the same. Essentially, you seem to have hit a plateau around 600,000 containers. As a result, truck tonnage has stalled because essentially they can't get any stuff through the ports to feed through to the trucks. And this is an index of all freight transport in the US, and you'll see that, it's plateaued. International air travel has yet to recover, and frankly, the latest Omicron restrictions are going to impact this further. I thought this is amazing, this chart. This is Hong Kong. Essentially, nobody's using Hong Kong anymore. Amazing.
Wow.
China is recovering, but well down on pre-pandemic. And if you look at US air transport, domestic actually has largely recovered, but international is half of what it was pre-pandemic. Now, when we finally get rid of the COVID virus and all its variants, I expect this to recover very strongly. But car travel is almost fully recovered in the US. On to other charts, Richard.
So this is the Atlanta Fed GDP now estimate, and it has taken a hit, which presumably is due to Omicron. So the GDP now estimate at the top shows that there has been a sudden spike down in the last few days, which is not good news. But as we say, the US GDP growth remains strong. So long-term demographic trends are suggesting that we are inexorably moving towards lower growth as people get older and retire. Their demands for goods and services, certainly their demands for goods drop. I mean, their demand for services changes from towards needing more healthcare and associated services. But you can see here that the percentage change in the working age population is declining in all countries except regions of the world except sub-Saharan Africa.
Yeah. So economic growth is a function of the increase in capital, the increase in labor, and technological change, total factor productivity. And what we're seeing here is the growth in labor is going to slow sharply, and that should feed through to lower growth unless you have a big jump in productivity. And there's no evidence of that.
And since 2016, funds have largely flowed into cash and bonds. So although the equity markets, well, certainly the US equity markets look extraordinarily overvalued, in terms of total inflows, the bulk of the inflows have gone to cash and bonds.
How much of this is central bank largesse, Richard? How much of this, that bonds, is the central banks of the world buying vast quantities of their own debt?
Well, exactly, Keith. Which probably, and that would seem to, on the face of it, would seem to explain why bond yields are so low and not expected to go up. The market distortions of QE.
A couple of charts on inequality from the FT. So this is the annual pay of the average S&P 500 CEO, which now runs at $15 million per annum. And that is over 300 times the average pay of the US worker. So the average US worker would have to work for 300 years to earn 1 year's worth of pay for the average CEO.
And that vast slug of stock-based compensation is hugely distorting to the incentives of the CEO. Their incentive is to get the stock price up. They don't really care how, because that's how they get most of their 15 million. And so it's not long-term business planning. It's short-term, how do I get the stock price up? And I think probably I'll do a share buyback.
Yeah. We, on this podcast, we are capitalists. But to me, the extraordinary pay of CEOs is a failing in capitalism. And it shows that boards are filling their own pockets rather than working for shareholders. They're all companies. There's a a principal agent problem, because shareholders essentially hire these managers to run the company for shareholders, but the assumption is they're working for shareholders, whereas management could also be looked at as primarily working for themselves and trying to get as much out of the company as they can during their brief tenure there.
It's all symptomatic of the financialization of the economy, Keith, I believe.
Yeah.
And a lot of these companies, the majority of shareholders are institutional in some form or another. Their incentives aren't the same incentives as the shareholder, the individual shareholder that they purport to act for. And so there is the financialization of the economy is causing huge distortions and it's been facilitated by ultra low interest rates and QE.
Global supply chain disruption is not going away. And this is a survey of US businesses and their expectations of when they think supply chain disruption will end. And the red bars are the latest survey. And you'll see the companies that aren't expecting it to end until 2023, although the peak is due to in Q2 next year. So long-lived and inflationary.
Also, I don't necessarily think that people fully understand the complexity of global supply chain disruption and the disruption that the disruption causes to the supply chain disruption, if you see what I mean. And you can get into a vicious downward spiral of supply chain disruption. And that, I think, is a danger as parts become harder to source for manufacturers who source the who produce primary manufacturing equipment. You then get to a point where you can't replace your capital or you can't put new capital in, and your productivity slows. Your ability to increase production and to streamline your supply chain disappears. So there is a danger that we move into a sort of scenario where effectively someone's poured sand into the gearbox.
But that said, Richard, we have been living with this for quite a long time now, and they are air freighting essential components. So hopefully this will begin to ease.
Yeah.
On that note, this is inventories by sector. So you'll see that this kind of greeny line at the bottom here is manufacturing, and they have very high inventories, whereas retailers have very low inventories compared to history, and wholesalers have slightly lower inventories. And I believe the reason why manufacturers have very high inventories is they've got loads of stuff they can't complete because they're missing components. If you think of the car industry, they have loads of semi-finished cars which they can't complete because they're missing chips, etc. So when the supply chain disruption ends, expect to see a lot of inventory coming out of manufacturers.
Yeah, but this is also my point, Keith, in that if manufacturers can't complete their manufactured products, then that has a knock-on impact. Unless those are final goods, final consumer demand, that has a knock-on impact on other manufacturers, which is where I get to my point of actually you can get into, I'm not saying we are, but there's a danger that one could get into a vicious downward spiral. Yes. And the longer this persists, so the sun's coming out. the longer this persists, I think the more the danger of that happening becomes.
And this is debt. So you see we've had a big jump in total indebtedness last year. It's a big leap in public sector debt, but also in private and household debt. Biggest jump in total debt levels in 50 years. Okay, finally, on to COVID. This is the R number. And the R number in England, which remember is how transmissible, how many people each infected person is infecting, is currently 5.5. And that means total number of cases in England is expected to double every 2 days. My own daughter has COVID, but she has yet to infect the rest of the family.
As does mine. And her whole household, she lives in a shared house. Her whole household have it.
Well, actually, amazingly, the rest of us have not had it. And we have all had the booster, etc. So evidence the booster works, which we will get onto. So these are cases, and you'll see the UK cases is going through the roof, as is the French, and the French have now banned UK tourists, and we are seeing increased restrictions everywhere. UK cases are going through the roof, and they are estimated. This is based on tests, and obviously you don't test everyone. So the actual case number is estimated to be well above 200,000 new cases per day in Great Britain.
The Omicron cases in Gauteng, which, if you remember, is where Omicron was first detected, and the daily new cases in Gauteng appear to be declining, and certainly the steep upward trend, the exponential upward trend, has broken. And the question is, how persistent will this be? How quickly will it start to tail off? I think, so anecdotally, in the UK, there are an awful lot of people who are infected currently. Yeah. And at some point that will itself start to reduce the R number with herd immunity for the Omicron variant.
Yeah, so it's going to be short and sharp. It's going to infect loads of people and burn itself out.
I was reading that the actual ability of the Omicron variant to shed active viral particles into the linings of the lungs is 70 times greater than the original COVID virus, which is why it is so much more infectious, because people catch it and they're breathing out vast quantities of the viral particles, far more so. So that's why it's so infectious. And actually, it has, as we know, it has 30 mutations on the spike protein, and a number of those mutations are very close to something called the furin cleavage furin cleavage site, which is associated. The presence of that is associated with greater airborne transmissibility, and of course, greater airborne transmissibility is associated with the production of more viral particles in the lungs. So this thing seems to be perfectly mutated to maximize its transmissibility through the air. And what I would say is, fortunately, it appears to be not particularly virulent. It doesn't appear to cause serious disease.
Very interesting. Thank you, Richard.
There we are. Fingers crossed. So this is some charts from the FT, basically showing the acute hospital bed occupancy in London is tracking above the historical average. It's actually sort of tracking the 2021 winter, last winter, but it's too early to say, basically. And then in the bottom left, there's this number of incidental admissions. What they mean by incidental admissions is people admitted who have Omicron. Doesn't mean they're admitted because of Omicron, and because it's rampant in the population, you would expect the bottom right chart to show that people admitted to hospital for other reasons have Omicron. So I think that graph actually is spurious in a sense if it's suggesting that Omicron is causing hospital admissions.
Yeah.
And but what we're not actually seeing is a spike in hospital admissions yet. And I would say that within the next 5 to 7 days, if we're going to see a significant impact of Omicron on hospital admissions, we will start to see it by the end of another week.
Yeah. I would also add that my own daughter has very mild symptoms of a not terribly bad cold.
Yeah.
And we've seen from the South African data that there hasn't been a big spike in either hospitalizations or ICU beds, ventilations. Now, thank you to Leebod on our Discord channel for posting this. And if you're interested in the details of this, come on to the Discord channel for it to be fully explained. But in summary, what this shows is the booster works. So the dark spots are the immune response of people who've had the booster jabs, and the white dots are the immune response of people who haven't had the booster jab. And it shows that the RNA booster jabs really change the immune response of people. So if you haven't had the booster jab, go and get it.
So moving on to equity markets, the FTSE All Share down 1%. Obviously, we had the interest rate rise from the Bank of England this week. The Stocks Europe is almost unchanged on the week, up 18.5% for the year. S&P 500 unchanged and up 24.3%. And the NASDAQ down 2.2%. Seemed to take quite a big hit after the Fed announced that they were going to advance tapering, but still up nearly 18% year on year. The topics up 0.5%, 10% year on year. Bitcoin down 1.8% to 62.5% change year on year. The pound versus the dollar slightly up by nearly 1%, but down 2.2% on the year. And it actually had a spike up when Bank of England increased interest rates, and it lost a little bit of that. And the dollar index has fallen off a little bit, but it's still up nearly 7% year on year.
So as a result of Omicron, fear is back. This is the CNN Fear and Greed Index, which you remember uses options pricing, etc., and shows that market participants are currently cautious.
So the one of the issues we're going to talk about today is the concentration in the S&P 500. So the S&P 500 is significantly up this year, which suggests that the stock market as a whole is very healthy, but it's not. And it is S&P is most concentrated since 1969. Concentration means that it is swayed by the movements in a few ultra-large stocks.
Yeah, and if you remember, in the late 60s, early 70s, the fashion was for the Nifty 50 in the US. The 50 largest stocks, which were forecast to have huge earnings growth in the subsequent decades. And of course, they subsequently collapsed. So, a precedent.
And this shows the NASDAQ breadth. So the white line is the price, and the orange line is the percentage of members of the NASDAQ index who are above their 200-day moving average. And it is less than 50% and dropping. So a lot of the majority of the participants, the constituents of the NASDAQ index are below their 200-day moving average, despite the NASDAQ appearing to be powering ahead. And this is a very good pie chart showing basically the 5 stocks that are dwarfing the impact of the other constituents. And Microsoft, Apple, Nvidia, Alphabet, and Tesla.
Yeah, what's interesting about this chart is, you see, Amazon is actually only slightly up on the year, as is Meta, which is Facebook.
So this is just an interesting issue. You might like to pause the video at this point and read these, but basically this is showing that internally all is not healthy. So if I just pick the penultimate point, 26.4% of the index are more than 40% below their 52-week highs. That is a lot of shares that have dropped more than 40% since their 52-week high. This shows a lack of health in parts of the US stock market. So moving on to Bitcoin and Ether. So Ether, they both had a fairly volatile but ultimately not very big movement week. And I've just drawn those little tram lines for Ether, showing that it's sort of possibly doing a flag pattern. Bitcoin is so the Ether log chart. So I like this chart, and as you can see, Ether is touching its logarithmic trend. You don't, if you've got Ether, you don't really want it to drop through that logarithmic trend line. So fingers crossed for Ether holders. I think the concept here, though, is that it is still the growth of these is based upon the network effect and the exponential growth in the network and the so-called Metcalfe's law. And as long as the network continues to grow exponentially, then the overall trend in the price of these also grows exponentially. That's the reason for holding them, if you believe it. I think Keith is highly skeptical. In fact, I don't think he's highly skeptical. I know he's highly skeptical.
Exactly. Well, the thing is, I would like to see how the network is growing, Richard. And while I say network, I mean active users.
Yeah, we'll see if we can get hold of a graph that shows that for the next week. And so Bitcoin is basically hasn't really gone anywhere for the last 12 months. Well, it has, hasn't it? It's up 61.8% on the year. So it hasn't really gone anywhere for the last 8 months.
Okay, on to energy commodities and another decent week. Crude has been incredibly volatile over the course of the last month, but it was up 1.1% on the week. Natural gas futures in Europe had an astonishing week. We will show you the graph today, but the weekly change is 23.3%, and that is including a big drop today. So earlier in the week, Dutch natural gas futures were astonishingly elevated.
Part of the issue with natural gas at the moment is that Germany is saying that the Nord Stream 2 can't open until regulatory issues are addressed, which are to do with the ownership of the transportation and pipeline physical asset holding companies. And apparently it's not going to get sorted out till the summer next year.
Yeah, and there are tensions with Russia over Ukraine, etc., etc. And also we will show you that the UK grid, as of this morning, there's only about 4% wind. So we're not getting much renewable energy at the moment. Coal had a good week. We're heading back up. It's up 4.7% on the week. Uranium was down 3.7%. Okay, so this is crude. And after extraordinary falls earlier in the month, it seems to have stabilized. Now, this is the cash flow yield of the energy sector compared to the wider S&P. You'll see that having had essentially 10 years in which the cash flow was terrible, it's now almost double that of the wider S&P. And this is the relative performance of the energy sector. And sadly, despite the enormous cash flows it is now generating, returns have not improved relative to the market, as I know from my own portfolio. And there has been a big sell-off in crude, and we've now gone from backwardation into contango. So what that means is the market is now paying you to store crude. So the futures price going forward is higher than the current price. But despite the sell-off in oil, inventories continue to fall. And the estimate for the fall in global inventories last week was 18.5 million barrels. That's 2.6 million barrels a day. We're consuming than is being produced. And long term, that has to be bullish. And just a chart showing that we are not investing. So this is capital spending compared to depreciation. And currently, depreciation is higher than capital spending. We need to
I think
invest.
one of the points here, Keith, is a really interesting graph, is that if you look at how oil energy consumption must have grown from, let's say, 1990 up till 2016, it would have been, and plotted that, you would see there was a growth in oil production along with a growth of capital spending to depreciation ratio. And now oil consumption actually is still growing and is projected to grow. And yet there is a huge divergence between those two, between that imaginary line I've described and this line of capital spending to depreciation ratio.
Yeah. And this is the EIA's US liquids report. And you see that actually there was quite a big drawdown last week in the US. Now, this is a chart from the FT, and it shows that after losing money relentlessly, US shale companies are actually making good returns now. But they seem to have found capital discipline. So they are not plowing that money back into growth. Now, the fall in oil prices has been driven by a massive cut in speculative positions. So the red line here is outstanding interest in crude futures, and you see big sell-off. And hopefully that means that speculators have cleared out their positions, and when they start rebuilding them, the oil price should start recovering. Now, this is Dutch natural gas futures, and this is a really frightening chart. So earlier this week, it had got above 140 euros. And the futures chart, which is the dotted red line, shows that the market is expecting very elevated gas prices to continue throughout the winter. So this is not just, a matter of a couple of weeks or days. And this chart shows, we look at top right, the light blue line is the Dutch natural gas future price, LNG price, and the dark blue line is Hong Kong, is in Japan. And what it's showing is that Europe is now competing with Asia for LNG cargoes. And we are now pricing out the rest of the world. So if you look at deliveries to South Asia, they have fallen. So that's India, Pakistan, and Bangladesh. Deliveries to Latin America have fallen sharply, and deliveries to the Middle East have fallen sharply as cargoes are diverted to Europe and Japan. This is the UK grid as of this morning. Photovoltaic, 0.2%, wind, 1.7%, hydroelectric, 2.2%. We've returned to using gas and coal because the wind isn't blowing. So what is happening right now in Europe shows the vulnerabilities of moving to largely renewable energy for power generation. When the wind doesn't blow and it's cloudy, you don't get any. And so we are returning to fossil fuels.
Today is not an extraordinary day, is it, Keith? It was quite a nice day. And effectively, it means that we can only rely on renewable energy being 4%, or probably less, during the daytime. Never mind at night. So
essentially, the switch to renewables, you need to keep all the old fossil fuel infrastructure there for the days when renewable energy doesn't flow. And that means essentially you've massively increased your capital costs. You need both all the wind farms and all the gas-fired power stations.
So I was reading about interconnectors this morning, which is fascinating. So the interconnection with Norway. So Norway produces a huge amount of hydroelectric power, and we have an interconnector cable from Norway to the UK. which transmits their surplus hydroelectric power to us when we need it. And when we generate surplus wind energy, we send it back, and they use pump storage schemes for hydroelectric power. It's very clever. And the estimate was that the UK saved 2 million tons of carbon dioxide production by using the Norwegian interconnector.
Very good. Interesting.
Yeah.
This is coal. After its big sell-off, it is now grinding back up. And I like this. Frankly, it just appealed to all my prejudices. But France, who has nuclear power, actually now have higher prices than Germany does. So it's not entirely true, but still, closing down all the nuclear power stations and then turning to coal. I mean, really. Uranium drifting off from its highs. Richard, anything to say on uranium?
No, it's a bit of a long-term play, Keith, I think, isn't it? And until people start actually building nuclear power plants, it's drawing uranium off to use, the price is probably going to be a little bit variable, like a weather vane in a breeze, not in a very light breeze, fluttering around.
Well, I think it's being driven more by speculative interest than by fundamentals.
Yeah.
Okay, on to...
I disagree with that, Keith. I just think the fundamentals are quite long-term, and the speculative interest is short-term.
Yes. Okay, on to industrial commodities, and a mixed week. Aluminium up 2.5%, up 35% on the year. Cobalt flat on the week, but up 120% on the year. And essentially, green metals have had a great year. Copper flat, up 23% on the year. Chromium coming off its mystifying bull run, down 5.6% on the week, but still up 48% on the year. Iron ore is the standout. So it was up 6.8% on the week, but is down 30% on the year as China has mandated that Chinese steel mills cut production in the second half to reduce power consumption. Lithium continues its amazing run, up 9.5% this week, up almost 400% year to date. And as we've discussed previously on this podcast, there's no shortage of lithium. It's just the fact we haven't really been searching for it because we didn't really have enormous industrial uses for it. Magnesium up 6.1% and is continuing to recover. Neodymium flat, but up 240% on the year. Nickel down 1.2% on the week and up 19% year to date. Tin, strange week, flat to downish, but up 94% on the year. And as you'll see when I show you the chart, the long-term chart of tin is astonishing. And ferrovanadium flat. So aluminium towards its highs. And if this is a long-term chart, this week, all the charts are going to be long-term charts. And, highest prices there have been since prior to the great financial crisis. And reminder, Goldman Sachs are forecasting that the aluminium market will move into deficit in the coming years, having been in surplus for many years now. Cobalt grinds higher. Copper, this is a long-term chart. Actually, despite the recent gyrations, copper price is very high. Chromium coming off. Iron ore ticking back up. Lithium grinding relentlessly higher. Magnesium bouncing back up. Neodymium at its highs, all-time highs. Nickel, and remember that we think the nickel market is in surplus. It still had a decent but not extraordinary year. Tin. It's the long-term chart going back to 1970.
interesting, isn't it?
Yeah, ferrovanadium flat and following the iron ore price. Richard.
Thanks, Keith. So precious metals had an interesting week because they got hit. Particularly silver got hit during the early part of the week, and or last week indeed. But they have bounced back. So gold is now back above 1800, having been down to about 1760. So it's come up 3% or so from its low point, its recent low point. Silver is up 3% on the week. Platinum almost unchanged, and rhodium almost unchanged on the week. Palladium down 1.7 on the week. The year-to-date change for all of them has been in the teens, or in palladium's case, nearly 30%, except for gold, which is only down 5% year-to-date. And I have to say, looking at the charts, and what's happened to the price of silver and gold since the Fed meeting is that they have perked up. So, contrary to sort of some expectations, that if you start to raise interest rates, which the Fed has indicated it will do, and you reduce QE, price of precious metals should drop. The actual response has been price of gold and silver has gone up. So it remains to be seen how that pans out over the course of the next few weeks. But it certainly isn't the market saying that's it, then the Fed has got inflation under control.
Yeah. So this is the long-term gold chart, and obviously a very disappointing year. But, when you look at the price of gold since 1971, when Nixon took us off the gold standard, gold has been an absolutely amazing investment. Silver, a less good investment and not actually a very good year. Platinum, well, we are awaiting the return of car manufacturing and the increase in demand for PGM metals for catalytic converters. So platinum has had a volatile year and indifferent couple of months. Rhodium, basically shut down all the car manufacturers. Demand for rhodium disappears. And same for palladium. Okay, moving on to rates. Now, remember that we've had inflation numbers in the UK this week. And so November, UK CPI came in at 5.1%, RPI 7.1%. So in that context, the UK raised interest rates to 0.25%. And if you invest in UK government bonds for 5 years, you'll get 0.6% per annum. And the 30-year will get you 0.91% per annum. Amazing. So yields did actually tick up very slightly at the long end this week. But really, bond market is astonishingly relaxed about inflation. And if you buy UK government bonds, you're getting massively negative real returns. Now, in the Eurozone, actually, bond yields fell in the periphery this week as COVID essentially sparked a flight to quality. And yes, that includes Greece. So Greek bond yields fell.
Keith is redefining the word quality, I think.
Yes. Now, this is an interesting chart, actually, from the market ear. And the yellow dotted line shows the Federal Open Market Committee's median dots, so where they expect US interest rates to be in 2023. And the other charts are all bond yields. So the 2-year is here, and that's only yielding 0.66%. So if the Fed is right, all these yields these yield curves are going to have to shift up. But 5-year forwards are astonishingly relaxed about inflation. They're barely moved. In fact, they're down from the summer. I mean, really, why are they down from the summer? Well, given the inflation has continued to surprise to the upside. Amazing. And EU government bonds, 10-year real yield, -2%, locking in for 10 years. Compound that up. And I like this. This is a comparison of the real rates in Turkey, the Eurozone, UK, and the US. And they're all pretty similar.
So what's the difference between us and Turkey, Keith?
Credibility. That's it. Just credibility,
Yeah. We've got Boris.
Good point. Let's move to Turkey. Okay, this is the UK 10-year, which, is complete unfazed by rising inflation. Same in the US. And this is the seasonality chart. Fingers crossed. The last 2 weeks of the year.
We've nailed it, Keith.
Yeah. Okay, Richard, what have you been up to this week?
Thank you, Keith. So my weekly change was very slightly down. So I had actually quite a good week in the, particularly in the gold and silver mining shares, and quite a poor week in the crypto world. And the net effect was not very much. My change for the year is a disappointing 8% up against the FTSE All Share of 12.1. Another quiet week for me. As viewers will know, I like quiet weeks, so I don't do anything. But I do believe that silver is due for a run, and I think it's due for a big run. And I have therefore bought some Pure Funds Junior Silver ETF on the basis that they are very highly geared to an increase in the silver price. Note that I haven't gone for any leveraged ETF. We covered leveraged ETFs a while ago and how bad they are for your wealth, unless your timing is absolutely spot on. So the gearing here is purely operational gearing. And that is, that's the sum total of my portfolio changes. My view is that precious metals will rise in 2022, just as it was my view that they would rise in 2021. This is the Junior Silver Miners ETF chart. And you can see the lightly shaded area is that the range that they've been in for a year and a half now. And the downward trend was where they went from the top of that range down to the bottom of that range. And they've broken out of the that downward trend from the summer, and have a technical analyst would say they have retraced and hit the top of that downtrend. So I'm expecting a bounce up. I use the word expecting advisedly. I'm hoping for a bounce up, and that's the that is the my report for this week, Keith. Short and I hope prospectively sweet. How was your week, Keith?
Thank you, Richard. Well, I had a shit week. Down 1.6%, only up 5.3% on the year. Long-term viewers will remember there was a brief moment a couple of months ago when oil prices were doing well, when I was ahead of Richard and the All Share. Well, that seems a long time ago now, as oil has come off, and I've had a really poor run, actually. But there you go. I mean, the thing that mystifies me is that, I've been absolutely right on oil. In fact, the oil price has gone up much further than I expected. So all my oil companies, and bear in mind, I'm 70% oil in my portfolio, have done really well on an operational perspective, but their share prices have gone precisely nowhere, which is very disappointing.
Can I offer what I think might be an explanation for that, Keith? I'm not saying it's a valid point of view, but so diversified energy, which is, we did a share talk on that quite a long time ago. And effectively, the price has gone nowhere. It's bounced around a bit. It has gone nowhere since we did the share talk on it. It's on a yield of 12%. Now, so if you think you're going to get a yield of 12% in perpetuity and interest rates are as they are now, you would think that the share price probably ought to adjust so you get a yield of maybe 4 or 5%. So why hasn't it? Well, is it because presumably people don't think that yield is going to be in perpetuity? And if you think that yield is going to only persist for the next 8 years, at which point the business will be valueless, then it is correct. Then it is correctly priced. And I think that's what's happening. People are thinking oil is going to disappear within the next 10 years.
Well, may they continue to do so, Richard, as the oil price goes through the roof, because we're not.
I think you're right, but I'm trying to sort of. I think you're right, and the logic for trying to work out is still about like pricing of cigarette companies, isn't it?
Yeah, no, that's true. I mean, the thing is, we're entering the dividend season, and I'm awaiting my dividends from BP and Shell. And whenever I look at my income, it looks incredibly healthy, actually, as all these oil companies pay out increasing dividends or they commence paying dividends. So, if I just live off the cash flow, they're very positive, and eventually you think that the fundamentals will start to attract other investors, as certainly the air starts to deflate from the tech bubble and all these companies with absolutely no earnings, their share price starts to decline. What has been disappointing is that the share prices of oil companies have been declining despite the fact they're making very good profits.
Yeah.
So no buys, no sells. And while we talk about energy, let's talk about 3 companies that we have covered on Share Talk, which are all exposed to rising natural gas prices. So the winner has been Serica Energy, which share price has done very well, thank you very much, and has been rising recently. And they have the Columbus field, which has just come on stream, but they can't export as much gas as they would like. They're operating at reduced capacity because the export pipeline is full. But that should change in January. So Serica are doing well. Independent Oil and Gas, now they have Blythe and Elwood fields in the southern North Sea, which are due to export to the east coast of England via the Bacton terminal, but the Bacton terminal needs refurbishing, and currently that has been delayed into Q1 2022, so they're not benefiting from the really elevated gas prices, and the share price has been good but not spectacular. Finally, Harbour Energy, which has been a huge disappointment. Now, they are a big, highly geared UK oil and gas company, which produces a lot of gas, and they have the Tolmount field, which is due to come on stream in Q1. And that will be a big field by the standards of the other operators we've covered, 15 to 20,000 barrels a day, mainly gas. But drilling results have been slightly disappointing, and the share price has been frankly awful. Earlier in the year, share price was £6.40. The oil and gas prices have shot through the roof. It's now trading at £3.57. Mystified. Anyway, that's it. We have this week put out a piece on the business cycle and what causes recessions. And I hope you'll all look at that, because that really provides the intellectual framework by which we are going to look at business cycles going forward. So please take a look. So next week will be the last weekly of the year, and that will be on Thursday. But I will be working on a review of all the companies we have done on Share Talk, which we will hope to record sometime over the next few weeks, and will be an interesting discussion, as a lot of them frankly have not done as well as we would have hoped, and value companies have generally been disappointing. But anyway, Merry Christmas to everyone. We hope to see you again next week. In the meantime, please can you press like and subscribe to the channel, and think about donating, as we will rely on donations. And in the meantime, it is goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.